The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A mixed bag of tech earnings puts the stock market rally on pause. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. It's an ugly one. The S&P 500 really losing now about 0.6%. That's being led, as Romaine said, by big tech. The Nasdaq 100 off by about 1%. Not enough to send a bid into bonds, which is curious. The 10-year Treasury yield higher by 1 to 2 basis points, but it is sending a bid into the dollar, Romaine, with your Bloomberg Dollar Spot Index higher by about 0.3%.
We got to talk tech because yesterday's tech earnings really did shift the tone a bit for markets. Microsoft investors, well, they're taking a look at the company's computing capacity crunch despite massive spending on data centers. Meta investors, they've been gobsmacked by Mark Zuckerberg, and now a fresh decision to borrow $30 billion to add to an already aggressive spend on AI. And while investors are more comfortable with Alphabet's investments, we're going to get a retest of that sentiment in about an hour with earnings out of Amazon. The amount of money that those four companies are investing in AI, staggering. At least a quarter of their combined $1.5 trillion in annual revenue, a ratio that belies the relative lack of return on that investment. But despite the bonfire of dollar bills burning in the background, some investors say, don't call it a bubble. The payoff is still to come.
There's obviously some overpricing in the market, but I actually don't think that we're in an AI bubble from this point of view of this is a vast societal change in the way that the world will work in general. And so when you think about a new way of doing things writ large, a lot of people are not understanding how large that addressable market potential is.
And we had a chance to catch up with Sheila yesterday, who actually helped to sort of build Microsoft's cloud business, now a cloud business that has turned into an AI business. Our next guest actually says he actually sees the promise of AI as well. Kamal Bhatia is the CEO and president over at Principal Asset Management. I'm pleased to say he flies into New York today to join us here in Studio 2. Great to see you.
Good to see you, Romaine.
I wish we had better weather for you here in New York. There's a monsoon outside. A bit of a monsoon in markets, too. I mean, you've seen the AI talk over the last 3 years. It has been, at least for public markets, the main driver.
Yep.
Do you have any concerns here that maybe we've gone a little bit too far with this?
Well, look, the level of investment is staggering. You know, we haven't seen numbers with T in front of it for a while. And so, you know, the AI investment train is real. I think the big differentiation in my mind is some of the very large mega cap companies are making levels of investments they've never had to do. You know, the history of these big tech companies has been they're extremely capital light. You know, they generate a lot of free cash flow, and now suddenly to participate in the AI transformation, they have to spend serious amount of capital, and they are turning to markets to help them in that regard.
Well, one thing I'm curious about, too, because this gets into the idea, at least for public investors, you have the idea of how you value these companies. And we should point out, not everyone's spending. We're going to get Apple earnings later tonight. They have famously not spent as much, maybe to their detriment, but I don't know, maybe being the slow and steady, you know, tortoise and all this, maybe that works out. But how do you value that? Because you're throwing billions of dollars at something for the potential that we have some sort of transformative effect on that company and the economy itself, but a transformation that might still be a few years off.
You're so right. Look, I think the challenge in this space is to get a good sense of valuation, you should have some understanding of what intrinsic value is. So our approach to this has been, we are big real estate investors, Romaine, and we've done a lot of data center investments with a real estate lens on it. I say it's easy to understand what land value is. It's easy to understand what it takes you to put up a data center. I think what gets more tricky is to understand the value of technology going into it, because it's going by leaps and bounds. And so my view is, our view has been is where we could get a good sense of valuation and we have an understanding of payoff in those investments, we'll participate. There may be segments where it's difficult to create a valuation framework, and that's the risk in this marketplace.
Well, I want to talk about the risk of overbuilding. I feel like I bring it up every show, and I feel like a broken record. But even, I mean, CEO Mark Zuckerberg of Meta was asked about this on the earnings call last night. You said, you know, when you approach it from the real estate angle, okay, you can put a value on a piece of land, on a building, on it. But when it comes to the technology that goes inside of it, it's reasonable to think that's going to get smaller, lighter, easier to cool, et cetera. So as an investor, how do you think through that risk?
So I think there are two ways to think about it. One, you want to participate in the wave, but be very have discretion on how you participate. You're essentially investing in technology that's changing rapidly. And our view remains is you have to pick the firms among not invest in everybody. You have to pick the firms that will succeed in that regard. I think the other view we have is, if you really think about this space, is it's going to affect every company. It's going to affect companies in the software space. It's going to affect companies across the investment universe. And there's more ways to participate in the AI change than just in the tech companies, where valuations, I would argue, are more reasonable, and everybody's going to participate in the transformation. You could pick healthcare, you could pick retail, and you could pick other spaces where you can still participate.
That's right. You've seen this sort of halo effect extend to other sectors. I want to talk about the nexus of public and private markets. And once again, I feel like Meta is a good example here, because today the big story is that they're to sell 30 billions of bonds in the public market. But then you think about that interesting structure that they put through, using a special purpose vehicle essentially to also raise a similar amount of debt. So especially when it comes to the debt markets, I feel like you have these issuers that are hopping back and forth between public and private markets, and it's hard to put anything in a bucket here. You are so right. I must say, some of these structures are getting extremely creative, and you have to look through them to understand where this is going. I think one thing is clear: the amount of investment in the space is incredible, and it's only increasing every day, every quarter, every month. I think the big tech companies, in my mind, are at the forefront of it, and their demand of what they need the public and the private markets to help them with is only going to increase over time. I think what is clear is their balance sheets can support it, even though they have stellar balance sheets. And they're going to tap into, as you said, the public bond markets. They're going to tap into the private markets as appropriate, as you see on the real estate side. And that will continue, because the amount of money required here has to come both from public and private markets.
I am curious then, too. I mean, you guys have a great survey out, a great report out about financial literacy. And this gets to the idea of sort of an investor class that is broadening, but also an investor class. And I think, and I don't say this to be disparaging, probably needs to educate itself a little bit more about what's coming down the pike. Are we ready for this? Well, thanks for bringing that up, Romain. One of the things we are very proud of is we do this annual survey on global financial literacy. And we as a firm are very proud because we do it across 42 countries. It's not just a US only survey. We've done it for a couple of years, and it really helps us understand where the state of financial literacy is, but there is a bigger purpose to it. It makes us better investors. So last year, our big focus was on the cost of education. This year, interestingly, we were just talking about debt and cost of debt is, what does financial literacy translate into helping people? If you're more literate, what does it mathematically translate in terms of you managing your debt? And so our interesting takeaway from that is a 1% increase in financial literacy has a 3% decline in people default rates on household debt. That's incredible. We have statistically mapped and said, look, we need to invest in financial literacy because one phenomena, the other side of this coin is we have incredible growth in marketplace, but not everybody is participating. And we need to understand how you could help society, not only help them participate in the growth, but also manage the debt here. And that's what we've been focused on. Kamal, always a pleasure. Thank you, Romain. Got to get you back here more often. Kamal Bhatia, CEO and President over at Principal Asset Management. And from one CEO to another, I had a chance to catch up with Starbucks CEO, relatively new CEO, Brian Niccol, on the heels of its latest earnings report. Niccol, of course, trying to engineer a turnaround for a company that had seen 6 straight quarters of contracting growth, finally posting a modest growth in the most recent period. Here's what he had to say about keeping that rebound going.
We believe this was a critical moment in our turnaround plan of the Back to Starbucks strategy. It was great to see once we got the Green Apron Service standard into the business, we saw a lot of really good things happen. Most specifically, our partners were set up with bigger rosters, more hours, and they were able to give customers better connection, great craft products, which then translated into transaction increases. As you saw in September, we had positive comps driven by those transaction gains. That continued into October, and we believe we can build from here because we've got a strong operational footing and really excited about what we've got coming for holiday. So we think it was a critical moment in the fourth quarter for the turnaround of the U.S. business. And when you think about North America, the thing that's great is Canada had a great quarter as well. They were, low, mid-single digit comp growth driven by transactions as well. And they've done a really great job there. And then when you look around the world, we had terrific successes in many markets, and most notably, China had its second consecutive quarter of comp growth. So it was a critical moment for us, and we're optimistic about where we go from here.
You've put a lot of emphasis on service, obviously, with the Green Apron Project. What does that look like in terms of staffing, though? I mean, you obviously have to hire more people, but more importantly, you have to retrain a lot of your existing staff as well. How, I guess, receptive have they been to that, and have you faced any challenges?
I got to give our partners a lot of credit. They really have embraced both the Back to Starbucks strategy and the Green Apron Service standard. And when I'm in stores, what I hear from folks is like, thank you. We're getting back to being a great coffee house again. Our baristas and partners, they love doing the craft. They love having the moments of connection with our customers, and our customers love it as well. And so the fact that we've staffed the stores up, and we've added more people, we've added more hours, it actually has set them up to be able to do their job, I think, with excellence. And, it's always terrific to be able to hire more people. And when you've got great leaders in the stores, they're able to train the new people, I think, really quickly. And we've tried to keep this very focused on what we're looking for, right? We want a great greeting when people walk in. We want a great experience at the handoff. We're working on doing these uplifts so then our customers have great seats if they decide to stay. And we've put some technology in behind the scenes to help put order to all those orders coming in, whether it's through the drive-through, mobile order, or in the cafe. So, we're seeing great responses from our partners, and I couldn't be prouder of the progress they've made in really short order. We've only been doing this since the middle of August.
Yeah, and with regards to the actual physical Starbucks locations, I mean, there are a lot of layers to what you're doing here. One, obviously trying to make the interiors a little bit more accommodating and comfortable, but at the same time also efficient. You're also looking to sort of create more, I guess, lower cost models for building and operating some of these locations. Are those two in conflict with each other, those strategies?
No, actually, they can work really well together. You can have great design, you can have a great seat, you can have a great atmosphere, and then also be very cost conscious. And that's what we're doing here, is we want to make sure all our base costs go into giving the partner the back of house they need to be successful, and then the customer the front of house experience where they love being in our coffee houses. And so that's what we're doing. These coffee house uplifts, we're able to turn these around in a night or two. We don't have to close the store, and the transformation is meaningful. The feedback we're getting from customers is really, really positive, both on the design as well as just the whole atmosphere, the vibe that they're getting. And I think the combination of the Green Apron service with this coffee house uplift just really gets people to a different place, and they believe now they're getting that Starbucks experience that, frankly, you don't get anywhere else.
How much will the pace of those uplifts pick up? I mean, you've only done a few dozen stores, at least in the most recent quarter here. I mean, you've got more than 10,000 company-operated locations right here in North America. So when do we start to see the other thousands of locations get that uplift?
Yeah, so we've done about 70 so far, and we are focused on this fiscal year getting over 1,000 done. And the good news is once we get that scale operation going, we build know-how, we will be able to then hopefully accelerate the build schedule accordingly into the out years, because we would love to touch all the stores that need it. And then the good news is, too, as we build new stores going forward, we're building the new stores with the right design package, the right experience. So we have some work to do with our existing coffee houses, but I'm optimistic we will demonstrate that we're able to do this at scale, and then we'll build on our ability to do thousands of stores going forward.
There is still cost involved in this. You had a restructuring charge in the most recent quarter. The sales growth is coming back. There are still some concerns about whether margins could be under pressure as you go through this transition. What do you tell investors who ask that question?
Yeah, look, I think the margins will follow the top line success, and I see no reason why we can't get back to earning what we used to earn even pre-COVID. So I'm very optimistic for where we can get to on the bottom line. Kind of the way we've talked about it is our future is we're going to have more transactions, a bigger business, and every transaction is going to be more profitable than it currently is today. I love the fact that our culture has really adopted this mantra of we're going to be better tomorrow than we were today. And the same thing is true on the bottom line. So that's where we're headed. And I'm confident as we continue to put transactions into the business, customers continue to experience the Starbucks experience, they see the tremendous value, it will flow to the bottom line, and it'll reward everybody accordingly.
I want to talk about the coffee and the food. Obviously, one of the biggest buzz right now around Starbucks is the add-on foam protein. I am curious. I mean, obviously, it's in the zeitgeist, but is there any way you can articulate whether it's actually been accretive with regards to sales and the bottom line? I mean, what do transactions look like for those protein drinks?
Yeah, so we're early days in the protein platform, but it's proving to be very incremental, which is terrific to see. One of the best early indicators is our rewards customers that had some low frequency, we're seeing their frequency pick up. We're also seeing our awareness build. And as the awareness builds and we see people try, whether it's a protein cold foam or the protein latte execution, we see them actually loving it and coming back and doing it more often. And in some cases, even doing it in the afternoon. So they may get a different experience in the morning, and then they come in the afternoon and get the protein latte solution. So we're looking really promising on this protein platform. Obviously, we'll learn a lot. We'll listen to what customers say. But, you know, I love the fact that over 90% of the drinks now, you can get protein added. And it's very much on trend with how people want to eat and drink. And so, look, I think this is a piece of Starbucks getting into the right health and wellness frame of reference,
right?
And then also giving customers the personalization that they want around protein.
I am curious about price, particularly in light of some upstart competitors that have come into this space, like Dutch Bros, as well as Seven Brew, Luckin Coffee, and a few others here. Do you feel like you need to compete with those names on price, or can you sort of maintain this sort of a relative premium or luxury model that I think Starbucks has had a perception of being?
Yeah, look, we're always going to compete, okay? And one of the things that I love is we're competing from a position of strength. And that strength comes from the fact that, you know, one thing I like to remind people is we are the biggest coffee drive-through business. We are the biggest mobile order or digital coffee business. Now I think we're also the biggest delivery coffee business. And then obviously we are the biggest cafe coffee business. And when we provide people the experience, meaning the connection, the community aspect, the humanity of Starbucks, combined with the craft of our coffee and the personalization, we see customers saying, this is tremendous value and it is well worth it. And so I always say to our team, like, we have to be on the offense. We have to recognize the scale that we have, and then we have to do the customer experience better than anybody else. And we are after being the world's greatest customer service company. And I think that's a place of strength when you compare a lot of the other competitors that you mentioned.
Before I let you go, Brian, I do want to ask you a little bit more about international strategy, particularly with regards to China. Starbucks has had a footprint there since at least the late 1990s. Bloomberg reported this week that you were close to finalizing a deal for a partnership with a private equity firm that would allow you to expand your footprint in China even further. How much further do you want to go with that, and how far along are you in sealing that partnership?
Yeah, look, I'm really excited for our China business. You know, they've had 2 consecutive quarters of comp growth. The team, I think, is really doing a great job of listening to customers, reacting, and building on the strength of the Starbucks brand. As it relates to finding a partner for our China business, this process, I think, has really, validated what I knew, which is China is a tremendous growth opportunity. And the process has also demonstrated to us that the partners that we were fortunate that came to the table are excited about getting this brand to go from 8,000 stores to 15, 20,000 stores. And their expertise is in the local China market. I think it's going to help our team get into those tier 3, 4, 5 cities faster and with the right execution so that we are able to build on this positive momentum that we have. So I'm looking forward to wrapping up the process, and I'm looking forward to our China team being 100% focused on just growing that business into the future in a big way.
You think wrapping up that process will happen before the Investor Day in January?
You know, you never know on the timing on these things, but, I love the partners that we're working with, and I'm optimistic that we're going to get this deal done in the not too distant future.
And that is Brian Niccol, the CEO of Starbucks, now about 13 months into his tenure. A bit of a rebound here in same-store sales growth. You can watch the full interview by just going over to Bloomberg.com/live/shows and navigating to the close, or by entering TV Go on your Bloomberg terminal. We'll be back in a moment.
Eli Lilly, Merck, and Bristol Myers Squibb all on the move today after reporting earnings this morning. Here to help parse through those results, I'm pleased to say, is Asad Haider. He is head of U.S. healthcare research and U.S. pharma analyst over at Goldman Sachs. So we have the board up. You can see a big warm reception to some of these results. Let's start with Eli Lilly. The news there that they raised their full year guidance, revenue from weight loss and diabetes drugs beating expectations. Asad, on the other side of that trade, you have Novo down on the heels of that news. It seems like Eli Lilly cementing its lead over its closest competitor when it comes to the U.S. market.
Yeah, Katie, thanks for having me. And you said it well, and I would completely agree with that characterization. As you sort of referenced, this was a duopoly between Eli Lilly and Novo Nordisk in the obesity market, and you have seen really over the last, call it 18 months or so, separation emerge in favor of Lilly. And I think what's happened is that as Novo Nordisk has been falling behind in terms of just where they sit in their positioning in the obesity market, at the same time, Eli Lilly has been solidifying its dominance in the obesity market. And I think there's also a question around Eli Lilly potentially having a better pipeline, a better range of assets across a sprawling obesity portfolio on both existing and next generation assets. And I think in terms of just near-term business momentum, as you saw today, the results were very reassuring. They just showed you that their obesity franchises are continuing to really deliver, which is really where it matters, right? And I think Mounjaro specifically, their overseas numbers were really good. They beat us by about 18% as well as consensus. And so I think what this quarter really showcased was just the dominance that Eli Lilly continues to have in the GLP-1 market today and how it continues to separate itself from the pack. And I think on the other side of that, there's obviously some news out there on Novo Nordisk making a bid for another next generation obesity asset. And I think that's probably weighing on that stock today as well.
Well, I am curious about that, Asad. I mean, we've been reporting about this deal for Metsera, and of course, maybe what is not going to be a simple deal, particularly if Pfizer gets his way. Is there a sense that they need this? They need to do this through acquisition?
Well, I mean, I'm gonna refrain from commenting on the mechanics of the deal and the what we can all see out there in the media. But I think the question really is for Novo Nordisk is that they do potentially, in the absence of any near-term key pipeline drivers, probably need to look towards externally sourced innovation to boost their pipeline. And so I think it's reasonable to see them potentially make a play over here. As you know from the Metsera proxy, as you can see, there were 7 bidders that were trying to vying to buy this asset, of which we now know that Novo Nordisk was one of them potentially. And so, I think from a pipeline perspective, it does make sense for them to lean further into next generation obesity assets, in contrast to Lilly, which already, like I said, is very well positioned across a lot of these emerging next generation obesity assets.
Yeah, Pfizer, which reports earnings next week, they have 4 business days to offer a better deal than Novo Nordisk. So we'll see. Asad, really quickly before we go, let's talk about what we learned from Merck. It was kind of a mixed read, and you've certainly seen that in shares.
Yeah, I mean, look, I would, Katie, characterize all 3 results as generally positive. Bristol's up as well, Lilly's up as well, and I think that's also relative to just where expectations were. Merck had run up a little bit into the print, and I think the question on Merck's quarter was just, it was a slight beat and raise, not of the same magnitude that you saw from the other 2, Eli Lilly and Bristol. And I think one thing that's probably weighing on Merck stock today is that one of their key growth drivers, it's a drug called Winrevair, which treats a form of hypertension, came in a little bit lighter than expected. And so, when you're headed into a big patent cliff like Merck is, you don't want to see underperformance from one of their key, what's promised to be a key growth driver. And I think that's probably weighing on the stock today.
All right, Asad, really great to get some time with you. That is Asad Haider. He is head of U.S. healthcare research and U.S. pharma analyst over at Goldman. Coming up, Penny Pennington, managing partner at Edward Jones. She joins us to discuss her firm's market outlook as we head into year-end and how they're helping clients position strategically for the 4th quarter. That conversation up next. This is The Close on Bloomberg.
3:30 p.m. in a rainy New York City. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. An ugly day in the markets. The S&P 500 really weighed down by big tech. Of course, you think about the results that we got last night, weighing on this market. Who knows if we'll be able to change the narrative after the bell tonight.
And it's been kind of a weird week because we have what is now the busiest earnings week that we've had, I think, ever, at least in terms of that. You obviously had a Fed meeting, which I think we've already forgotten about.
Yeah.
And then, of course, there was a lot going on. The president was, of course, traveling through Asia, struck some frameworks of deals, maybe potentially
Concepts
here
of a
with
plan of a
regards to
deal.
trade. Yet, when you put it all together, you would think the market would be a little bit more enthusiastic about it, but maybe a lot of this was already priced in.
Well, what's interesting, I mean, again, a lot of this for the equity market, it seems like they're squarely focused on what we're seeing out of big tech earnings. Not enough, though, to send a bit into the bonds. It feels like the bond market did not forget about the Fed. Basically, Jerome Powell pouring cold water on the concept of a December rate cut. That is still the story in the bond market, the equity market following a different narrative today.
Yeah, well, let's get a read here on what investors are thinking, particularly individual investors, and no company really knows them better than Edward Jones. And pleased to say, joining us right now is the managing partner over at Edward Jones, Penny Pennington, joining us here in Studio 2 in New York. Great to see you, Penny.
Great to see you both.
We talk a lot on this show about investor sentiment, and I mean, you can look at the price action, and I guess you can divine that investors are optimistic, or at least they're certainly confident in what's going on today. But is that a true reflection of how people feel, particularly individual investors?
On average, I think it's a true reflection, but realize that especially at a company like Edward Jones, who has 100,000 engagements with our clients every single day, every client has a story. Every client has a different set of needs and wants and wishes, and everything that you just described, they're very interested in how it's going to impact them and their family and their plan. And so that's what we work to personalize, the insight and the perspective and the opportunity that comes from all of that. I would say that broadly, our clients are pretty sanguine right now. The reasons that we can tell that is that they are continuing to put money into their investment accounts. Interestingly, they are removing money from their investment accounts. Their spending is up. So generally, we believe that that means that they are feeling fairly confident about the go forward in the near term. What's important right now with all the things that you just described, though, is that there probably is volatility coming. I think I just read that this is the 5th strongest 6-month rally in the last 75 years, since last April. So that means we're probably ripe for some volatility. And
but with that, I mean, is this the type of scenario where people, they walk into an Edward Jones branch and they say, get me out or protect me, or is it the opposite? Are they saying, you know, make sure that I'm in and take any additional money I have so I can ride this wave?
Generally, it is that. And the reason that it is that way is because our financial advisors work with our clients to take a longer view and to take the emotion out of the market. Now y'all put a little bit of emotion back in the market sometimes, right? And so when we focus people on their medium and long-term goals, albeit with the right kind of planning, asset allocation, and an emergency cash, we set up their plans so that they can ride some of this out, and so that when the markets do get volatile or go lower, that they can take opportunities, that they can rebalance, that they can invest and take advantage of that opportunity.
Well, you mentioned all the different daily engagements that you have with your clients. When your clients are thinking about the medium, the long term, what do those conversations sound like? What topics keep bubbling up to the surface?
Yeah, I've just come back from Minnesota and from Florida, client engagements and being with our practice teams. Every conversation that I have with a client turns to multi-generation. They talk about their parents and they talk about their children, and they talk about the opportunities that their kids have today to save and invest, to buy a home. What does AI mean for their jobs and their job prospects? So every conversation turns real personal that way, and then they're looking for insight for how do I invest for the longer term. They're very interested in understanding these unique new products that are being discussed in the markets. Cryptocurrency is one of them. Privates is another one of them. They want perspective on how those might or might not fit into their investment management. situation.
I think that's really interesting. I mean, when you talk about cryptocurrencies, yes. When you talk about private assets, too, I feel like a lot of the discussions that we have tend to gravitate towards, okay, if you are planning for your family, for the long term, how do you actually get access to some of those markets? And there's been various structures, various fund structures that seem to be popular right now. But, you know, I wonder where Edward Jones falls on that. Like, what is the proper vehicle to access some of those exposures?
Right. Well, it'll be different for different kinds of investors. Our high net worth clients in our Generations program, which is our most customized and bespoke experience for high and ultra high net worth clients, those with more complex needs, they will often find, and we believe that that a small allocation to privates is really important for them. Public equities and fixed income have become more correlated over time, and so the diversification that can be gained from privates is appropriate. But private investments are not appropriate for my 30-year-old children, and so we won't be representing them for those kinds of clients. The more traditional asset classes are going to be right as my girls get started on their investment journey. The other thing that we have to recognize is that private investments are structured differently than the public investment vehicles that we are used to. The liquidity, the price and value transparency, that's going to be a very different experience for investors. And they need to understand that. The asset managers are coming together in unique kinds of partnerships to build those sorts of investment vehicles. But this is a new day in terms of access to those markets. And the rules of the road still apply. What is your risk tolerance? What's your time horizon? How open are you to the ups and downs in the market? And what are the goals that you're trying to accomplish? Those rules of the road still apply.
But on the private side, I mean, obviously there's a determination of whether it's appropriate for each individual investor's scenario. But I am curious as to how you staff up or how you prepare your staff to educate folks when they do come in and ask these questions. I was just recently at a private credit conference, and I was astonished at how many advisors were there in the room relative to past years. And it gets to the question is, I guess, have you been approached, has Edward Jones been approached by any of these private capital firms about working together in some way? Because what you do and that whole wealth channel now is their sort of entry point, at least the way they see it into the future.
Absolutely. I mean, they know what I just shared, 100,000 engagements a day with Main Street investors, 9 million clients. And so we have been approached and, in fact, are working with various companies, enduring strategic partners that we've had for years, to ensure that we get this right as we open these vehicles to more investors.
I do want to go back to something you said that, you know, when it comes to private assets, maybe not appropriate for a 30-year-old. Tell me why not, because that actually seems a little bit unintuitive to me if you think that private markets are riskier. So maybe that's something that, you know, would be appropriate for a younger investor.
I love it that you're calling me on my own rules. That's perfect. That's perfect. Well, you know, so maybe I ought to take your lead on that and say, a 30-year-old with less complex needs, who's just getting started in their investment journey, we want to make sure that they have a good experience. Interestingly, the experience that new investors have in the markets at the time that they begin investing shapes their risk tolerance for the rest of their lives. And so if they have a really bad experience, one that they don't understand, or a really rocky experience at the very beginning of their investing career, often their risk tolerance goes lower and goes too low over time. It's that, oh, I got bit once, I don't want to do that again. And so we want to make sure that those rules of the road are really well understood by clients at all stages in their investing journey. And that's the nature of the conversation that our financial advisors have with all the families they serve.
Real quick, only have a little bit of time left, but with regards to just where you see Edward Jones going next here, I mean, there's been a lot of talk about the pursuit of a bank charter and just the general evolution of Edward Jones into, I think, whatever you want it to be. I guess the question is, A, why pursue that, and B, what is the end goal?
Yeah. Well, what we know in the marketplace is that there is a shortage of financial advice. People are aging, things are becoming more complex. They want a great marriage of a human financial advisor that's backed up by good technology, and they want a financial hub for their short, medium, and long-term needs. So Edward Jones has an ILC bank charter in front of the FDIC today, an application for that. We have just announced a partnership with U.S. Bank for what we call Edward Jones Everyday Solutions for cash management, short-term checking accounts. We've established ourselves as a financial planning firm so that we can help clients across all aspects of their financial needs, and we're meeting clients where they are. Our high net worth clients through our workplace solutions, through financial planning, and digitally and through technology. We've been here for 7 generations of investors. We want to be here for many, many more.
All right, Penny, have to leave it there. Hope to have you back soon.
Thank you.
Really enjoyed this conversation. That is Penny Pennington. She is managing partner over at Edward Jones. Now, let's talk about one of the earnings movers on our radar. That is Mercadolibre. Joining us on the heels of the results is the Mercadolibre CFO and Executive Vice President Martin de los Santos. Martin, great to have you with us. So it was a beat for you on many measures. There was particular growth when it comes to Brazil, when it comes to Mexico. Talk us through, though, some of the drivers from where you're sitting that led to these numbers.
Hi, thank you for having me. Pleasure being here. Yes, we are very excited about the results that we saw this quarter. I think the main driver continues to be the investments that we're making on our platform to continue to bring people online. Remember, keep in mind that penetration of e-commerce in Latin America continues to be very low. So it's a large opportunity to continue to bring people online. And the same thing we could say about fintech, where millions of people in the region have not been financially included by the traditional banks. And this particular quarter, we saw very strong results in e-commerce in Brazil, where we made a very big investment last quarter by lowering the free shipping threshold from 79 reais to 19 reais. Just to put it in perspective, those are about $3.50. And that was a big investment, but we've seen the results. You know, the number of items that we sell on the platform accelerated significantly from 26% growth last quarter to 42% this quarter. So very excited about results throughout the ecosystem.
Well, Martin, on that point, though, I mean, are you concerned at all? I understand the top line growth that brings. Are you concerned about the impact on profitability, on margins, after having lowered that threshold?
This is a great question. This is something that we discuss with our shareholders, in particular those that have a long-term perspective. When you see the growth opportunities that we have ahead of us in Latin America, the most important thing for us is not to miss those opportunities. And that requires investments. This quarter, we grew by 39% year on year our top line. This is the 27th consecutive quarter in which we grow our top line by more than 30%. There's no other company, no other public company in the world that has delivered that. And the reason why we do that is because we don't focus on short-term margins. We look at long-term value creation. So we invest behind our ecosystem. This particular quarter, we invested in Brazil, and we have seen the results. We're also investing in the credit card, in the fintech part of our ecosystem, and that's also giving us positive results. So I think we manage for long-term value creation, as I mentioned before. In the short term, some of these investments might put a little pressure on margin, but we're confident, and we have done it in the past, that this will drive growth, and the long-term perspectives for margins should improve as we scale and as these investments mature.
Well, Martin, one of the investments that you are making, of course, is AI as well to improve search. You said recently that the transition will be more of a continuity than a change for us when it comes to sort of seeing the impact that AI has on your business. I was hoping that you could give us some more examples of what exactly that means.
Sure. We have been investing in AI or developing AI or implementing AI throughout our ecosystem for many years to help us with fraud prevention, with credit scoring, with search. Sorry, the light went off here. And more recently, obviously, CX is an area where we have improved significantly the way we interact with our users. We have been able to sustain the growth that we have sustained with the same number of people because we implemented AI. We are using AI to make more productive the 20,000 developers that are working on developing our platform. We recently launched agentic AI both on our commerce and our fintech platform. On fintech, you have an advisor that helps you with some of the tasks that you have, scheduling, sending money to, making payments, or getting money out of your account, those type of things, and give you advice on how to interact with our platform. On the commerce side, we have a seller assistant where we have a million sellers operating on our platform that gives them advice on how to operate with us and create videos, for instance, to list the products on our platform. So a lot of different fronts. I would summarize it as some of them are cost saving and some of them improves the user experience with Mercadolibre and Mercado Pago.
All right, Martin, great to get some time with you. Really appreciate it. That is Mercadolibre CFO and Executive Vice President Martin de los Santos. Meanwhile, we're at session lows in less than 15 minutes to go until those closing bells. This is The Close on Bloomberg.
And there's more ways to participate in the AI change than just in the tech companies, where valuations, I would argue, are more reasonable, and everybody's going to participate in the transformation. You could pick healthcare, you could pick retail, and you could pick other spaces where you can still participate.
Kamal, Bhatia over at Principal Asset Management, kicking us off to the close 50 minutes ago. And while certainly this whole market is in AI to a certain extent, it actually kind of is.
Yeah.
Take a look at what the market's doing right now, Katie.
Absolutely. Now at session lows on the S&P 500, down 0.9%. A lot of that pain coming through with the NASDAQ 100. Your big names that reported yesterday, a lot of them lower today. Maybe investors spooked by the amount of CapEx that is planned. I do wonder if OpenAI were a public company, what would it be doing today?
Who knows? Meta's down 11%. That's huge.
Yeah.
And then Microsoft's down 3%. But then you have Alphabet, which also reported last night and basically said, we're still, setting as much cash on fire as we can. And investors are like, yeah, bid that stock up.
Well, the thing is, when it comes to Microsoft, when it comes to Alphabet, the AI use case is a little bit clearer there. When it comes to Meta, do they need to spend, I don't know, $1 trillion on AI infrastructure? It's not as clear, Romain. It's a more difficult and nuanced answer.
Well, let's pose that question to our next guest as we move closer to the closing bells. Erika Klauer is CIO at Science and Technology Partners. And Erika, I'm just going to steal Katie's question here. I mean, a lot of money's being spent here. Are you comfortable with it?
Well, I think it's a very good time to take a little bit of a longer term view. Of course, the markets have been very strong this year for a lot of these key players. And so at Science and Technology Partners, we try to look out over the next 3 to 5 years to make sense of what we're seeing today. And what I would say is that we look at global GDP and we look at the section that is basically technology or knowledge driven, and that's about a $30 trillion market today. And as you pointed out, and many of the guests that you've had on today, the generative AI can add significantly to that. In our view, it wouldn't be difficult to see that 30 trillion expand to 40 trillion. So taking a step back then and looking at these CapEx numbers of about $1 trillion to $1.5 trillion in the next 2 or 3 years, that seems like a reasonable return on investment. Yeah. But also, as you point out, it's not for everybody. There are those that are spending responsibly and looking for a good return on those investments, and others that seem to not have as much emphasis on the return.
Well, on that point, though, I mean, because an analyst I spoke to this morning made a really great point about this idea of Microsoft and Alphabet, and the idea that even if they do overspend, and I put that in quotation marks, the idea is that they're basically spending on compute capacity. So if for some reason the AI bubble does pop, it's not like there won't be demand to some extent for that excess capacity. Meta does not have that. Amazon reports tonight they have that. Apple, which, as you know, has not spent as much, not as feverishly, if you will, on AI. I am curious if this ends up being kind of one of those tortoise and hare situations where kind of the folks on the sidelines, if you will, like an Apple, might end up being one of the bigger beneficiaries once this all shakes out.
It's a great point, because one of the things we don't yet know is how we will access generative AI. We know that we can access it today through our laptops and certainly on our phones, but I think Apple's in a unique position to advance that technology and that access to that technology, whether it be through those end market devices, or even something new that we haven't even seen yet. Apple is an extraordinary vendor, not only in terms of its scale on the hardware side, but also in the ecosystem that it offers. And so this is, in my mind, a very important AI player over the next several years.
Interesting. Of course, we'll get more details from Apple coming up very soon. I want to talk a little bit more about OpenAI because we referenced that reporting coming from Reuters last night that OpenAI is maybe thinking about a 2027 IPO. Perhaps we'd get some details next year. And Erika, you made the point in the commercial break that this isn't entirely surprising from where you're sitting.
Sure. I mean, I think every company that is as visible as OpenAI is, particularly as they are really looking to raise visibility amongst the consumer, it's very smart to go public. And also, it's a very important retention tool for employees to have that stock-based compensation. So it makes a lot of sense to me that OpenAI would be looking at an IPO. And if we think about the entire ecosystem of generative AI, OpenAI has really led the charge. It really was 3 years ago that they were the first vendor to really present a usable LLM for most users, whether it's a consumer or an enterprise, to pose questions and have material generated in response to those queries.
And Erika, part of the reason that this caught my eye, of course, it's OpenAI, so anything they do is interesting at this moment. But, you know, we've been talking a lot about the fact that you have companies being able to stay private for longer. They can get all the funding that they need in the private markets. They don't necessarily need to go public. OpenAI, obviously an extreme example, so maybe we won't have this sort of scenario again. But you think about the trillions of dollars, $1.4 trillion of commitments that they made. This is a company that actually does have to go public, and I think that's fascinating.
I think that you're absolutely right, and I think that one of the things that we'll be watching very carefully is that path to profitability. What the company is building it and expecting that they will come, but what exactly will be the path to profitability, the ultimate operating margins at scale? These are critical issues that we need to have answers to.
So, Erika, I am curious, as we get sort of, I mean, we're pretty much through, I guess, the heart of sort of the big tech earnings season, at least after tonight. But it gets to this question here about current valuations, but more importantly, long-term growth. And I don't think anyone doubts the long-term growth for most of these companies, even if in the short term, there may be some questions about their spend. Is this sort of one of these sort of transformational moments where the big winners in all this are going to be those companies that either aren't public or maybe don't even exist, similar to what we saw during the dot-com boom, where a lot of the winners in that really weren't actually part of that bubble, like, for example, an Alphabet?
So I think that generative AI is a very large concept, and so it needs to be broken down into several pieces. As it turns out, on the compute side, those entities are largely public. And it's become quite clear that there are a handful of companies that are positioned to not only capture the lion's share of the revenue pie, but more importantly, the profit pie associated with that compute. And those are publicly traded companies. Then on the software side, we are seeing real world examples. Many of your guests have talked about them today, ranging from public safety to e-commerce to genomics, that are actually recognizing and posting profits today using generative AI. And many of those companies are public today. But in terms of the LLM, you are correct that we still have not had OpenAI come public just yet. So we'll see if that actually comes to pass.
Erika, always a pleasure. Erika Klauer, CIO at Science and Technology Partners, on a day where we're seeing 5 of the Mag 7 on the back foot today, including an 11% drop in Meta. After the bell, we get a slew of earnings once again, including from 2 of the biggest heavyweights in this market, Amazon and Apple. A full breakdown of all of today's coverage and a push ahead to those earnings starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with a global simulcast. Carol Massar, Tim Stenovic, they join us from the radio booth as we bring together our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Yesterday, guys, we faced a fire hose of earnings. We get quite a few more today, including out of some big names like Apple and Amazon.
I thought you maybe forgot for a
Suspense.
moment.
I almost did.
Hey, listen, there's
I'm getting old, Carol.
You're not that old. But there's a lot coming at us, and it's tough to keep on top of it. But these are two big ones, and the AI story will certainly be important, and there's a few other things for those issues, as well as how well the iPhone is selling, right, Tim?
Yeah, speaking of that, Apple up 0.6% as we speak going into this print. Amazon down 0.3% on the Amazon side. Katie, obviously interested in anything they say about AWS, but also how they're thinking about the holiday shopping season and the consumer actually doing that buying.
Yeah, absolutely. A really interesting read on the consumer, even though it's AWS, of course, that investors want to hear about, especially because it's been perceived recently to maybe be losing some market share to its cloud rivals. So those are some of the concerns that they're going to try to put to bed after the close today.
Yeah, and it gets to this idea, too, of sort of what investors will reward. And I think the trade today where you had Meta and, of course, Alphabet come out with their earnings, and Microsoft, I should say, all sort of basically saying we're still burning cash like crazy. Meta gets hit. Microsoft gets hit. Alphabet, well, it's up about 3% here into the close.
Maybe they're just monetizing it better, you know? I don't know.
And I should just point out, we get a slew of earnings today. It's not just Apple and Amazon, but it's names like Coinbase, Roku, Gilead, Reddit, Atlassian, GoDaddy, Strategy, Weyerhaeuser, Zillow, and Twilio. The closing bells here in New York. It is going to be red across the screen for most of the major indices here in the U.S. The Dow down 0.2%. The S&P down 1% even. The NASDAQ indices down about 1.5%. The Russell 2000 down about 0.8%. And the one bright spot out there, it's actually the Dow Transports, Carol Master, up 0.9%.
That's kind of fascinating. All right, I'm going to go back to the S&P 500 as I normally do. 235 names in that index, folks, gaining ground on this Thursday. 266 to the downside, 3, Katie, unchanged.
All right, you take a look at the sectors. Not looking too good here. Only 3 sectors in the green. You can see a lot of pain coming through the tech sector on this day. In terms of what did well, real estate, which is a little bit curious, up about 0.7%. Financials and healthcare, some of your lone outperformers on a day where really it seems like a lot of the market wanted to fall.
All right, let's get to some of the individual gainers. A lot of red there on that screen. But Google finishing off its best levels of the session, still good for a gain of 2.5%. And we got Amazon out.
Amazon earnings crossing the wire right now in the third quarter. We're going to start with Amazon Web Services. Net sales for that division, $33 billion. That's light. The street was looking for $32.4 billion. So a miss for Amazon Web Services. As far as total sales for the company, that came in at $180.2 billion. That is a beat. The street was looking for 177. We'll just round it up to $178 billion. EPS side, $1.95. The street was looking for $1.58. An operating margin coming in light at 9.7%. The street was looking for 11.1. So just to round up here, operating margin is a miss for the quarter, and Amazon Web Services net sales are a miss, though top line sales as well as the full bottom line adjusted EPS are a beat. You see the shares there moving up about 8%.
Yeah, absolutely. And you take a look at the press release. Andy Jassy, president and CEO of Amazon, talking up the strong momentum and growth across Amazon as AI drives meaningful improvements in every corner of our business. Some comments on AWS too. Andy Jassy saying that AWS is growing at a pace we haven't seen since 2022, re-accelerating to 20.2% year over year. And you can see maybe some of that being expressed in the shares right now.
And we got a forecast coming out now, guys, here on the fourth quarter net sales. The company saying that it's going to see a range of about 206 to 213 billion. The street was looking for roughly about 208 and change. So basically guiding around what the street had already sort of priced in. As far as operating income for the current quarter, the company says expect 21 to 26 billion. So a wide range. The street was looking for something in the middle of that of about 23.8, Carol.
So Katie looked at the commentary from Andy Jassy on AWS. On the stores side of things is what I'm looking at right now. Andy Jassy calling out expanding same-day delivery of perishable groceries. They've expanded that to over 2,300 communities. They'll do that by the end of the year. They plan to double the number of rural communities with access to Amazon's same-day and next-day delivery. Still looking for any commentary on the consumer and how they're feeling. And look, we're going to get a lot of questions about those layoffs that we learned about earlier this week as well.
AWS growing at a pace pace we haven't seen since 2022. There's some commentary from Andy Jassy over at Amazon. Man, that stock, Amazon is up 10% here in the aftermarket. So investors liking what they got here, Katie.
Yeah, absolutely. Significant for Amazon. You consider that relative to its own history, it's the cheapest among the big tech names going into that print. But let's take a look at Roku shares coming through. Full year net revenue forecast meeting estimates here. They boost that full year net revenue forecast. They met their estimates on the look ahead, but you can see that their shares are falling 10% post-market right now. They see full year net revenue $4.69 billion. They had seen $4.65 billion. The estimate had been for $4.66 billion, but still you can see the shares really taking whack in the after hours, now down 14%.
Yeah, I just want to point out too, just real quickly here on Gilead. Gilead actually out with its results as well. It looks like a sort of softness on a couple of key measures, but let's go back to Amazon here because the shares continue to get a strong bid here. The company now saying that it can re-accelerate AWS growth to 20.2% year over year, though we should point out in the most recent quarter, growth in that unit was already about 20%. So we'll try to get you some more details on that. The company also talking about the costs for some of the layoffs, saying that it is estimated that there were about $1.8 billion in severance costs in the most recent quarter, as well as $2.5 billion in costs related to a legal settlement with the Federal Trade Commission here.
Okay, but that was the most recent quarter, so that doesn't account for what happens in the current quarter. I'm getting more numbers here from Amazon, worth going over some of these. They're worth repeating. Net sales for the third quarter up 13% year over year to $180.17 billion. Online stores net sales up 9.8% to $67.41 billion. The company saying that subscription service net sales excluding FX up 10%, AWS net sales excluding FX up 20%, earnings per share $1.95 versus $1.68 quarter over quarter, operating income coming in $17.42 billion versus $17.41 billion year over year. The estimate, $19.72 billion.
All right, Zillow dropping in the aftermarket. Let's go to the numbers. Third quarter revenue, folks. That's a beat, $676 million. The estimate on the street was $670.9 million. Third quarter adjusted EPS, 2 pennies better, 44 cents versus an estimate on the street of 42 cents. The fourth quarter outlook, this is always key. Company, Zillow, seeing fourth quarter revenue, $645 million to $655 million. So that too is above the street estimate of $644.3 million. And mortgages revenue, $53 million. That's above the estimate of $50.2, but nonetheless, Zillow down about 1% here in the aftermarket.
We've been talking about the rapid rise in shares at Amazon. Amazon not the best performer in the after hours trade. It is Atlassian, ticker TEAM, shares up 12% in the most recent quarter, its fiscal first quarter. The company came in with a big beat on the bottom line, $1.04 a share for EPS. The street was looking for 84 cents. Cloud revenue coming in above estimates too at about $998 million. And the company guiding for its fiscal second quarter, the current quarter, saying that revenue overall will be about $1.54 billion above street estimates, and it sees cloud revenue in the current quarter, year over year, rising 23%.
Okay, I'm looking at Coinbase, shares higher by just about 1% in the after hours. The third quarter total revenue coming in above estimates ever so slightly, $1.87 billion versus estimates of $1.8 billion. Coinbase third quarter trading volume coming in just shy of estimates at $295 billion. Third quarter subscription and services revenue coming in above estimates at $747 million. Third quarter transaction revenue coming above estimates at $1.05 billion. Shares not moving too much in the after hours, bouncing between gains and losses, down just about 0.1%.
Interesting that trading volume missed on expectations for Coinbase. You think about all the volatility that we've seen in Bitcoin and crypto overall, but not exactly translating into big volumes for Coinbase, at least relative to expectations. Let's talk about Reddit, though, getting those numbers out. Their third quarter daily active users, that figure actually beat estimates, coming in at 116 million. The estimate had been for just over 114 million. You can see the reaction in shares right now. Then you think about the third quarter net income. That measure, big beat there, $162.7 million. The estimate had been for $104 million. So a beat for Reddit when it comes, of course, to daily active users, a very closely watched metric, and also their net income shares up 11% in the after-hours trade right now.
All right, so movement by Twilio as well, the cloud computing platform. This company talking about the outlook, seeing fiscal year adjusted operating income of $900 million to $910 million. That is above what the street is looking for. The estimate is $867.9 million. Also, fiscal year organic revenue, they're looking for up 11.3% to up 11.5%. They had seen 9% to 10% growth. So again, we're seeing that one remain almost 6% higher here in the aftermarket.
And as we look at some of the big gainers in the after-hours trade, keep an eye on Floor & Decor, the home floor company, if you will, saying that it's going to elevate its president to CEO. Bradley Paulson, who had been president of the company for some time, will be taking over as CEO for Thomas Taylor, who will be elevated to the chairman role here. Those shares up 7%.
Hey, just want to go back. Oh, I'm sorry, Romain. I just want to go back to Amazon, if I may, which has been popping here in the aftermarket. One of the things that investors were looking for is, too, their investments in Anthropic, a key rival to OpenAI. Third quarter 2025 net income includes pre-tax gains of $9.5 billion included in non-operating income from their investments in Anthropic. So, again, this is something that is certainly key, and it'll probably come up on that call. All right, guys. That is a wrap. A lot of earnings dropping for us on this Thursday. That is also a wrap from our cross-platform. Romain and Katie, of course, finishing there on the close, continuing their analysis of this earnings after the close. We are continuing here on Bloomberg Business Week Daily, and we will all see you again, same time, same place, tomorrow.
Keeping an eye on shares of Amazon up 9% here after third quarter sales beat the average of analyst estimates. 13% growth on the top line for Amazon Web Services, the all-important division. $33 billion in revenue, 20% higher than what it was just a year ago, though we should point out that's relatively in line with estimates. And the company, of course, providing some guidance that seems to be giving maybe a little bit of ratification here to the AI trade. Let's bring in, actually, before we get to that here, I just want to point out Netflix, actually now crossing the wire here. The company reporting a 10-for-1 stock split. Katie Greifeld. We're going to get you some more information on that here, but that's just now crossing the wire. Netflix announcing a 10-for-1 stock split. Those shares higher by about 3%. Let's go back to Amazon. Scott Devote joins us right now. He's equity research analyst over at Wedbush Securities. And Scott, a lot going on this afternoon. But let's talk about Amazon. Let's talk about AWS, and let's talk about that AI spend. Are you comfortable with the numbers that you saw today?
It's hard to keep up, yeah. But the AWS numbers and the overall numbers for Amazon here, this is the cleanest quarter this company's had in some time. There's a few normalizations in the quarter related to the operating income that you reported that were one-time items. So when you adjust for that, they actually beat on operating income. They moderately beat on revenue. But the most important line item was the 20% AWS growth, because now you're going to start getting a bigger contribution from Anthropic in the AWS business as well. So there's kind of an upward trajectory in terms of growth rate going into 2026. And that's been the predominant reason that's held the stock back. I think kind of possibly on the verge of Amazon kind of becoming that next Google trade that happened in 2025, where it's a company that's been somewhat left for dead, the multiples compressed, and you're just at the beginning of an acceleration in the core business.
I'm curious, though, as to sort of what you think Jassy is going to do with this sort of, I don't know if you call it this sort of just gift that's been put out there by this AI trade here, but is he really looking to be in direct competition with the other hyperscalers, or is there some way that he's trying to differentiate AWS and really, I guess, Amazon overall?
Well, I think that Amazon's very conscious of overbuilding because it just overbuilt on the retail side on the pandemic. And I also believe that Amazon's trying to provide a service at which it can offer, in some cases, less expensive compute, which is what led to the dominance that it's had in its legacy cloud businesses, which they're doing with the training year that they just recently launched in coordination with Anthropic. But I do think we're going to have a differentiation in product portfolio. Unfortunately for Amazon, up to this point, there's been a lag in terms of the development of the growth rate related to the AI compute in the AWS platform. But that's what's starting to normalize now. And I think 2026 is set up to cost a very strong year for this company.
All right, we're going to hope to get that connection reestablished. It is interesting to see this momentum in AWS because we were talking about this in the simulcast before the numbers came out, that there had been this perception sort of haunting Amazon's share performance that maybe they were falling behind or at least losing a little bit of ground when it comes to the competitive cloud landscape.
Yeah, and it gets to this idea sort of how investors are sort of looking at these companies, right? The idea that you have businesses, like as we saw yesterday, all pretty much spending the same amount, or at least relative to their size here, but they're being rewarded in different ways. And it seems to be a bet not so much on what they're spending on now, but the idea of what that payoff is in the future. That's why you saw the weakness in Meta, because not everybody is sold on what that payoff is going to be. I think people see the payoff a little bit better for Alphabet. And based on the market reaction that we're seeing in Amazon today, I think some investors see the payoff there as well.
Absolutely. I mean, you think about the risk of overbuilding that we keep talking about. Maybe if you're one of those companies, you'll have a little bit of a better time trying to transition out of that if we do end up overbuilding. For Meta, that path isn't as clear. I will say before we move on, when it comes to the AWS momentum that Andy Jassy was talking up, you know, talking about 2022 levels, when you think about that AWS outage that we had a couple weeks ago, does that hurt the momentum in the current quarter? We'll have to wait 3 months to find out, but certainly something to keep an eye on. Let's stick with Amazon, though, and bring in Jake Clay, who started an Amazon delivery firm in 2022 before quitting last month due to rising costs. Jake ultimately dissolved the firm and is now in the process of filing for a business bankruptcy. Jake, he's the former CEO of JWP. He joins us now. Great to have you, Jake. So you have a really important and unique perspective when it comes to basically these franchise owners, if you will. So I was hoping you could just give us some perspective on the margin squeeze that you describe in some of the notes that you sent over to our producer.
Yeah, absolutely. So when I initially started this business, you know, it was very exciting. We were making a lot of money. We were ramping up. And so during this ramp process, you see nice profit margins. But as time progresses and goes on, you know, you have rising industry costs across the board. So you start seeing higher insurance rates. You start seeing employee wages going up. You start seeing services that are needed. Those prices start increasing. And then you have a hard time with keeping up, you know, because the way that Amazon pays us, it doesn't actually compute directly to the market increases. So whereas Amazon is showing massive profits and earnings, we as DSP owners continue to make less every year following those first 2 years of ramping up.
Well, Jake, you know, as I said in the intro, it was rising costs that ultimately led to your decision. Give us a little bit more detail. I mean, where did you really see those costs move higher in different areas of the business?
So particularly like with my insurance, when I initially started, my insurance rate was relatively manageable. I didn't want to spill the numbers, but it was relatively manageable. But when we got into going into our 4th year of renewing our premium, we were paying like almost $600,000 a year. And with those type of costs, you either have to say, do I want to do this for free or do I want to, you know, exit the program? And I think that's what most DSP owners do. We exit the program.
Well, I am curious, Jake. I mean, you guys, I mean, not necessarily just you, but we heard from some other DSP providers and this idea that they did go to Amazon with this. They did offer some concessions with regards to price increases, though I was kind of surprised. It was like a 20% increase, and then I saw it was like the 12 cents per package. But it's not just Amazon. I mean, we just had UPS earnings a couple days ago. They're also moving a little bit deeper into a similar type of program for last mile delivery. And I am curious to just how you would sort of look at the sustainability of the business model, not for the UPSs and Amazons, but for people like you. I mean, are people like you, or your peers, I should say, because you're already out, can they even stick by this?
It is not a long-term sustainable business model. And I honestly believe Amazon knows this. They keep a bench of DSP owners ready to go at a moment's notice to jump in and take, you know, vacated places or new opportunities. And so it's not a sustainable model in regards to what they pay us. You know, I mean, like when you have all these rising costs with these other businesses, there's no way you can keep up with it for long-term sustainability. So I think the short-term is a short-term plan for Amazon to keep new people coming in, to change those safety metrics to that incentivize us. They constantly change them, the rules that govern them. And so we make less money, we get less bonuses, and then the rising costs continue. And it's like, the only person that gets left out in the cold is the actual quote unquote DSP owner or franchisee, as Amazon labels us. But I don't believe that this is a franchise opportunity. I don't believe it's a real business opportunity. I think what Amazon should label it as is, hey, we're going to bring you on as regional managers and we're going to allow you to make this amount of money, and then we'll profit share with you, because that's where we miss out. Like, we don't get any of the profit sharing factors that Amazon's employees get. And I think that's where the difference lies.
Do you get a sense in the time that you worked with them that they are committed long term to this e-commerce retail strategy, the e-commerce retail strategy that, of course, made them what they are? But, of course, Jake, I don't know if you heard our previous conversation. This is also a company that has kind of morphed into something else. I mean, it's not really an e-commerce company anymore. It is basically a cloud computing company. And I am curious if you saw any sort of sense here that maybe executives just have other priorities.
I do think they do. A lot of me and my DSP cohorts, we speak often and we think, and there's been chatter about it from Amazon's internal, that they are going to move into a position where they get rid of the DSP program completely, which actually makes sense. I mean, when you look at all the factors of how Amazon controls every aspect of your business, not just a portion of it, every fraction of it. They control everything. They have a hand in everything. They know if I short my employees on payroll 10 cents, they know. And so if they control every aspect of it, it's relatively easy to say, hey, how do we move into a situation where we can start cutting back on DSP owners and start using artificial intelligence or, AI controlled vehicles to do the deliveries, which is actually happening now. So I think it is definitely moving in that direction.
All right, Jake, we really appreciate getting your perspective, much different than some of the perspectives we get on this program. Jake Clay is the former CEO of the former Amazon delivery company, JWP. And we should point, we did talk to Amazon about this, and they have stated that a lot of the anecdotes that have been shared with Bloomberg by what they say is a small number of delivery service partners, quote, don't reflect the experience of the vast majority. Amazon also says that it conducted its own financial performance of about 648 of those contractors and found that about 80% of them generated annual profits of at least $100,000.
Well, Amazon shares right now about 10% higher in the after hours trade. But let's take a look at some of the other after hours movers, because boy, there's a lot of them. Coinbase higher by almost 3%. They reported actually trading measures that missed expectations, but shares up about 2% right now. Reddit beating when it comes to, of course, to their daily active users. That is a very important measure for social media companies. And as such, Reddit shares higher by about 5%. Cloudflare, too, a little bit higher right now. Their fourth quarter revenue forecast did beat estimates. That's good for a gain of about 0.9% in the after hours trade, Romain.
Absolutely here. And let's take a look at another mover to the upside, and that is Zillow, up a couple of percentage points here in the after hours trade after the real estate marketplace reported earnings, a beat on several key metrics. Revenue, $676 million in the most recent quarter here. EPS at 44 cents a share for the most recent quarter, and guidance for the fourth quarter that says that expect revenue for the current quarter in a range of $645 to $655 million, the low end of that range, just above the average of street estimates. Jeremy Wacksman joins us right now, pleased to say, the CEO of Zillow Group, to talk a little bit more about the performance. And your core business did well, Jeremy, and I am curious as to what drove that. Was there sort of macroeconomic factors behind that, marketing, what?
Yeah, thanks for having me. Q3 was a great one for Zillow. As you said, revenue up 16% year over year, and the growth was really across the board. Our for sale revenue, which is mortgages and agent revenue, up 10%, and our rentals marketplace, our rentals revenue up 41%. And what's driving that outperformance against a housing market that's up mid-single digits is this integrated transaction strategy, building software for buyers, sellers, and renters to use Zillow more and connect with professionals and get more transactions done with our software and our partners. That's coming to life in more places. So that's what's driving the revenue growth in for sale. That's what's driving the revenue growth in rentals. And that's what's driving a great Q3 for us.
I am curious about the home loans business. I know a small part of your business. There was some decent growth there. What are your ambitions for that, Jeremy? Does that need to be bigger, or are you comfortable with where it sits right now in your portfolio?
We expect that to be a bigger business for us over time. 80% of all buyers need a mortgage, and those buyers are shopping on Zillow. They're using Zillow to find their agent, to find the home of their dreams, and they want a one-stop shop. They want the ability to transact all in one place in that Zillow app. So being able to offer them Zillow home loans as one of their choices of financing, it makes sense from a consumer experience standpoint. And then it's a great business because it's more efficient for them to use one platform and get multiple services. So you're right, it is very small today. It is growing nicely. It's growing double digits and has all year. We would love to see that business continue to grow over time. And as I said, the strategy there is really offer that service to our buyers inside of Zillow, offer it to our agents who are working with those customers, and just become one of their loan offerings for more of those transactions.
Jeremy, I'd love to get a little bit more detail when it comes to the breakdown of buyers versus renters, because with mortgage rates still at the levels that they are, you know, one of the narratives out there is that actually you take a look at the monthly payment, and for a lot of folks, it makes more sense to just rent versus to buy something. And I'm wondering, when you take a look at the trends on Zillow, whether that's still the case, or are we starting to see that shift?
Yeah, unfortunately, it is still a real affordability crisis in the housing market. And one way to think about that is just where are things versus pre-pandemic. Home prices are up nearly 100% from pre-pandemic levels. So we talk a lot about mortgage rates and the rise in mortgage rates from those lows, but it's really home prices that are making things unaffordable. Rent affordability, rent prices have only gone up about 30–40%. So it's still more challenging from pre-pandemic, but it becomes more affordable to rent versus buy in many markets. And you're seeing many folks who are trying to be first-time home buyers, that's just out of reach, and they are choosing to rent again. The good news for Zillow is by offering both of those marketplaces, we can help them with those needs, right? You see our rentals business growing incredibly rapidly, right? And that's now more than a quarter of our revenue. Those renters are tomorrow's buyers. So yes, we're helping them find a place to rent, but we're also helping them get ready to buy. We are helping them report their rent to the credit bureaus to start building their credit score to get them ready for that home loan. We're helping them with tools where they can understand what they could afford when they go shop. Because most of those folks, as you point out, they are what we call dual tracking. They are thinking about, could I buy or should I re-rent? And having all those options in one place is really what they need to make that decision.
I hear what you're saying, and you know, in some cases you're preaching to the choir as a renter who would like to buy, but I want to talk a little bit more about what the rentals market has meant for you, because a lot of folks think of Zillow as a home buying app, a home buying website, but the rentals market has been a big driver of your growth. I would love a little bit more detail on that and where you see that evolving as it comes to your business, the rental market versus the buying market.
Absolutely. Rentals is a fast-growing business for us, and it's a really great experience for our consumers. You know, our mission is to help more and more people get home. You can't do that if you're not helping renters get home, because there's so many more renters than buyers and sellers every year. And what's great about our rentals business is it's really solving the fundamental problem a renter has. There is no one database of all the rentals. You have to scour everywhere, online and off, to find a place on a very compressed time frame. So we set out to try and organize as much of the inventory as possible. And we now have the most listings. We have 2.5 million rental listings on Zillow, everything from those big buildings to the single family homes that are for rent in your neighborhood. That is what brings renters to Zillow. You want to find a place, you want to go where there are the most places to look for. That's why we have the largest audience now. So Zillow Rentals has 36 million unique visitors per month coming to Zillow. It's the largest audience. Those factors are now why the revenue is growing. Right. Advertisers, big property managers who are looking to fill their vacancies, they want to tap into that audience. And so they're what's driving the revenue growth, up 41% in Q3. Yeah. Multifamily revenue, those advertisers are at 62% year-over-year revenue growth.
All right, Jeremy, really appreciate you taking the time after earnings. That is Jeremy Wacksman. He is Zillow Group CEO. Of course, a lot of earnings on the wire right now.
Yeah, just going to go to a strategy real quick here. Of course, basically the carrier for Bitcoin these days, beating on several key metrics. The net income and revenue numbers almost immaterial here, $128 million in revenue in the most recent quarter. But the guidance that the company is giving for the year, seeing EPS for the full year of $80 a share and net of about $24 billion. And that's based on a year-end 2025 Bitcoin price target of 150K. Katie Greifeld.
All right, let's turn now to Apple. We are moments away from results with the iPhone maker projected to report an all-time revenue record for the September quarter, topping $100 billion for the first time. Bloomberg Tech co-host Ed Ludlow joins us now. Ed, so the anticipation is high.
Yeah, and in that quarter, you have 2 weeks of sales of the latest generation iPhone 17. So that will be a big contributor to a September quarter being $100 billion or more for the first time. It's not without headwinds, though, right? In Greater China, the iPhone 17 Air, the ultra-thin variant, did not go on sale because regulators wouldn't allow its eSIM design. How much of a factor is that? But there is this recognition that Apple's services business globally is starting to meet the story that Apple wanted. As the installed base of devices grows around the world, Apple's broader offering on services has gained traction, even if there's a question mark around AI.
Yeah.
On the other hand, other divisions like wearables, home, etc., have performed poorly over multiple quarters.
Hey, Ed, so I am curious, though, on that AI front, I know Apple's gotten a lot of criticism, somewhat unfairly, about its spend on AI or lack thereof. Does it matter? Because, I mean, we are, when this report comes out, probably going to be talking a lot about iPhone unit sales of iPhones. When do we need to start talking about AI and whatever spend they might do in that space?
Talk to a lot of investors every day who hold a lot of volume of Apple shares in their funds, and they say, why are we talking about near to $100 billion in capex for these companies and only 10 for Apple? Comes up on a daily basis. At least with the iPhone 17 generation, there is an argument that that phone has the hardware in it, so that when Apple get its act together on software and AI, you already have the device that you need to do all of the AI tasks that Apple says are coming in the future. But there is an absolute frustration out there that Apple isn't spending more, and they keep pointing to R&D, which is just an expense on the balance sheet. They want to see major capex. You're right.
Do you think that the CEO or CFO will address that on the call at 5 p.m. tonight?
If they're asked by the sell side, and so if the sell side's watching, do us a favor and ask the question.
All right. Excuse me, Ed Ludlow, the co-host there of Bloomberg Tech. Apple earnings crossing the wire right now. Let's get right to it. It does look like they met estimates here on several key metrics here. EPS in the most recent quarter coming in at $1.85. That beats the average of street estimates of $1.77. On the revenue side here, which is a start off here with iPhone revenue, $49 billion. That's up about 6% here, year over year. Total revenue for the quarter, $102.5 billion. That's relatively in line with estimates. The street was looking for $102.2 billion. Mac revenue, $8.73 billion. Services revenue, $28.8 billion. Products revenue, $73.7 billion. iPad revenue, $6.95 billion. I should point out, Katie Greifeld, all of these numbers pretty much in line or just a smidge above what the street was looking for.
And still, you can see that Apple shares now moving lower after hours, down about 3%. You take a look for some of the flies in the ointment. Perhaps you find one when it comes to Greater China revenue, for example, coming in at $14.49 billion. That is a year-over-year decrease. The estimate was for $16.43 billion. So a big miss there. Maybe that's what investors are seizing on to, because as you say, Romaine, when it comes to a lot of these measures, it looks like Apple performed. We should point out total China revenue down about 3% in the quarter. Operating expenses also up as would be expected here. As we bring, as we continue our coverage here of those earnings crossing the wire, let's bring Gil Luria into the conversation, head of technology research over at D.A. Davidson. And Gil, I know you've been relatively comfortable here with the way that this company has been managed. When you look at the sales numbers, particularly on the product side, you look at the revenue on the services side, Gil, does that match up with valuation and the rise that we've seen in the stock over the past 3 months?
Not quite. And in fact, that iPhone number is a little light. I think that we were expecting closer to 50. And the stock, which has had a nice run up in the last few weeks, really had embedded in it an expectation for a big upgrade cycle. So being a little less than that doesn't necessarily bode well for the fourth quarter in terms of iPhone sales. So I think that's why you're seeing a little bit of pullback in the shares. And let's not forget, Apple is still a darling. Apple trades at the highest multiple of the Mag 6, in spite of the fact that even with a good iPhone cycle, it's going to have the slowest growth of the group. And that's because people love the product, love the company, love the stock for historical reasons. But that's being challenged by the fact that, again, they grow the slowest of their peer group, and yet they trade at the highest earnings multiple.
This gets to this idea, though, too. I mean, we've always talked about just how sticky and powerful this Apple ecosystem is, iPhone ecosystem, at least we should say here. What sort of breaks them out of that? And I mean, where they take that ecosystem and leverage it to something better, and I mean, I guess to a certain extent, more dynamic, for lack of a better phrase?
Well, I think as you were discussing with that earlier, part of the conversation here is how do they leverage how sticky their ecosystem is, how much they know about us, how integral they are into our lives, into introducing AI products that can drive an additional leg of growth and can drive a bigger iPhone upgrade cycle. That's what we're waiting on. And that's okay for Apple. They've never wanted to be first to something. They never need to be fast. They just want to get it right. And so they're being deliberate about introducing these AI capabilities, but ultimately that's the only potential for incremental growth above and beyond where we are now. Because behind that, we need a new form factor. We need glasses, we need goggles, we need a new form factor to drive another leg of growth.
Right.
And that looks to be farther out. At best, we're going to get a folding phone next year. I'm not sure how close we are to another iteration of Vision Pro or glasses that look like Meta Ray-Bans.
Well, we are getting some commentary from Apple CEO Tim Cook in the earnings release, talking up their record quarter of revenue, saying that today Apple is very proud to report a September quarter revenue record of $102.5 billion, including a September quarter revenue record. Also talking up, of course, that lineup, which you referenced. I do want to get your thoughts, though, on what we saw in China, Gil, because there was a massive miss there when it comes to their China numbers. Greater China revenue coming in at $14.5 billion. The forecast had been for $16.4 billion. So, I mean, you think about what could be weighing on the stock, Gil. That is a massive miss.
That's right. So if we can count on anything China to contribute to Apple, it's volatility. The quarter-to-quarter results, they vary so widely, and often the checks that we hear ahead of a quarter are directionally wrong or completely wrong, as is the case this time. Some of that has to do with some selling up front last quarter. They had better activity last quarter. They probably sold into the channel more than the market required, which is why we're seeing it down this quarter. China is now less than 15% of revenue for Apple. It used to be more than 20%. So it's becoming less and less important to Apple. All it really contributes is volatility.
Yeah, it certainly seems that way. I will say, you take a look at Apple after hours now, paring that loss to just 1% or so. So we're about 30 minutes away from that earnings conference call, Gil. I mean, what would you expect to hear from Tim Cook and company, and what do you want to hear?
Really more commentary about how the iPhone cycle is shaping up. The preference for the Pro and Pro Max models is one of the most important things out there. So we need to see the balance between units and average selling price, which one of those is driving the growth, drove it in the September quarter. What do they expect for the next quarter? The iPhone Air seems to have fallen a little flat, can't even sell in some markets. So we're going to have to find out what their plans are for that, if there's anything they can do to accelerate that part of the growth into next quarter, or is it helping them drive the ASP higher because of the more Pro and Pro Max sales? So the focus really will be on that. Obviously, the services number is good. Investors will be happy about that. So any commentary that can extend that double-digit growth into the next quarter will also be very well received.
All right, Gil, really appreciate your instant analysis here. That is Gil Luria, head of technology research over at D.A. Davidson. Meanwhile, let's dig into Apple's iPhone sales numbers. We heard about some green shoots in the China market earlier this month. Doesn't look like we're really seeing them right now. Let's discuss with Nabila Popal. She is Senior Director of Data and Analytics at IDC, specializing in mobile phones, PC monitors, and other consumer devices. Great to have you with us. So you take a look at IDC numbers. This was a record-breaking quarter for Apple in terms of shipments. But then you take a look at revenue for the iPhone, Nabila, coming in at $49 billion. That is just shy of estimates. And I wonder how one record didn't translate into another.
Well, that's a really good question. I think because obviously there's lots of, different pieces. Definitely the iPhone makes a huge part of Apple's total revenue, right? Majority of 50% share. But if you just focus on iPhone, I think this is a phenomenal year, like you said, and like you see in our data, this is the record high, highest Q3, calendar Q3 ever for Apple. And this is, I think, exceptional because given, everything that we've been dealing with, right? And you can see, obviously, the economic challenges, the headwinds, the geopolitical challenges. And this was a phenomenal launch. And of course, 17, and there's a lot of chatter about the 17 and how well it's been doing. And of course, a little bit of challenges with the Air. But we can't deny, right? Coming out in this economic climate, with all the uncertainty and inflation, for Apple to come out with a record-breaking quarter, and also ahead of the total market curve. So the total smartphone market grew at about just over 3%, but Apple came in at about 4% growth. But again, record high shipments. So I think that's pretty good news, and especially even in China, we're seeing positive growth. So it's looking good.
But even still, Nabila, I mean, let's talk about China a little bit more. And I should point out that Apple actually flipping into positive territory right now. But when it comes to Greater China revenue, it came in well below consensus. It was a massive miss, really. And overall revenue coming in about 12% below the consensus estimates. I mean, how much does Apple right now need China? Gil Luria's perspective is that it's becoming less important. All it contributes is volatility. I would love to hear your thoughts.
Sure. I think nobody can deny, no matter how much Apple is trying, right, with strong growth, double-digit growth in emerging markets. Its growth in China has been challenged. Like I said, right, this was the first quarter after, almost 2 years of negative growth. So it is finally coming into positive territory, but no one can deny that China remains the largest market for Apple, and competition is really heavy there, right, with a lot of loyalists and towards Huawei, and overall competition, and of course a lot of consumer favoritism towards AI. So I would say the AI piece is also hurting Apple in China, rather when you compare it to the rest of the world, where Apple is really growing much stronger.
Well, but how did they get that back, Nabila? I mean, you had the refresh of the phones, and I understand that typically is a catalyst. I understand that the upgrades that we had this time around weren't necessarily life-changing. But when you start to look at some of the phones, a lot of phones that aren't available here in the U.S., particularly some of the Huawei phones and others, and you look at the features there, I am just curious as to what that catch-up looks like. If people in China and some of the other non-U.S. nations become so entrenched in the non-Apple products, what is the catch-up ability that they have?
I think this is a broad statement to say that globally that we're seeing other consumers being entrenched into non-Apple products, right? Apple still maintains a really dominant share of the premium market. And they haven't lost hold of that. Of course, certainly competitors are coming up, but I think the biggest competition that Apple sees is certainly in China. But overall, globally, we see really strong growth in the segment that Apple plays, which is the premium, and they've maintained that ASP. We see, year over year ASP growth in iPhone, and I think this is what is going to help drive, and especially next year, if you look at the portfolio up ahead with, when the Fold comes out, this will really also help Apple break through, especially also in China, where foldables are doing quite well.
Well, let me add an addendum to that question, and this is more just about the growth overall in the smartphone market, not just for Apple products, but overall. And when we talk about the ability for additional growth, most of the discussion that I've heard has been about, obviously, some of the third world nations that are still on non-smartphones, if you will, and the idea that once you start to see people upgrading to more advanced designs, that will benefit potentially Apple and obviously the Android makers as well. Are you seeing that as well?
We're seeing overall, like the smartphone, definitely we don't see movement from across OSs as much, but certainly more from Android coming into iOS rather than from iOS going into Android. And this is, again, very interesting and it's not, I don't think counterintuitive, but it's counter to what the headlines are saying, right? That because And I do agree that the Android phones and the Android players are phenomenal in terms of what they have brought, especially with the latest and greatest AI feature. But what Apple has done this quarter, at least, and what I think will help them continue to drive growth in the holiday quarter, especially, is gone back to the basics, right? With design and product differentiation, trying to hit different demographics, and simple thing as design changes to the back of the Pro Max, as well as bringing the base model, more premium features than ever. That's really helped move the needle for Apple, and I think that's what has been the game changer here for Apple, right? And I think overall, as technology is moving really fast, Apple still has some time, we believe, to catch up. So, we will see how this holds into next year.
Right. It's really interesting to see the after-hour share movement right now up 1.7%. Remember, the initial read, the first blush move to these numbers was to send the stock lower. Different story right now. Nabila, you think about what's coming from Apple in terms of the pipeline when it comes to the iPhone. Of course, we have this lineup that Tim Cook and company have been talking up. Does a foldable phone excite you? Is that going to be part of Apple's growth story going forward?
You know what's really interesting and excites me is to see how much that Apple's entrance is going to change this market. So we've been seeing foldables from the Android players for about 6-7 years now, right? And finally this year we saw increased momentum with the Samsung Fold 7 really breaking through some of those barriers in terms of the changes it had. It was really well received, but Apple, but the still overall foldable market still is a niche segment, right? But when Apple comes in, this is what I'm excited to see, that, I don't think the foldable itself will be very different from what the Android players are offering, but it's what Apple is going to do to the overall segment. I think it's going to bring a lot more excitement, and definitely double the size or, significant growth to the overall market. So that's what I'm interested to see. And even in our survey results, when asked consumers, would you be interested in Apple foldable, the interest continues to grow, with almost 40% of consumers in the U.S. market saying that, yeah, they are interested in seeing that. So that was, that's what I'm excited to see, the impact on the overall segment and turning it from a niche to possibly more.
We should point out just real quickly here for our viewers, as we were speaking, Apple shares that originally dropped on the back of that earnings report. The shares now have reversed firmly in the green, now up about 3% here. In addition, of course, to what has been a record quarter in terms of sales, $102 billion in revenue, the best September quarter that it's ever had in the first September quarter here. Remember, they're on that fiscal year that we've seen above that $100 billion mark, Nabila. It gets to this idea of how much you even need to grow in terms of on a percentage basis. Is this, when you start to look at either refresh from existing customers or new adoption by new customers here, what types of percentage increases are you sort of modeling going forward?
So, this is a great question. I'm really glad you brought up install base, because that's what is really going to help Apple move forward. Aside from the interesting product lineup that they have and the strong updates or innovation, we have about 500 million units of iPhones that were bought in between 2020 and 2021, and that's when the last bump happened, right? The largest growth that we saw in the last 5 years for Apple, as well as the overall market. And given the average life cycle of smartphones, especially Apple, is about 4 to 5 years, this is literally about the time where most of those consumers, again, I meant 500 million, not 500,000, but 500 million iPhones that are, primed for upgrade, and that is what's going to drive growth in the next 2 years. So yes, maybe developed markets might be a little bit flat, but we're going to continue to see strong. I mean, we saw in our data over 20-30% growth in markets like India, almost again very strong double-digit growth from markets like Turkey and other Asia markets. So emerging markets will continue to drive the growth, as well as coming from strong installed base of refresh.
All right, Nabila Popal, Senior Director of Data and Analytics at IDC. A close look at Apple, and now hitting session highs in the overnight session.
Yeah, pretty stark reversal there, now up 4%. Let's take a look at that move in context, because we're sorting through some of your biggest names. Apple, as we mentioned up top there, 4%. Amazon extending gains right now up 12% in the after hours trade. You add it all together, you're taking a look at the Qs right now. That tracks the NASDAQ 100. You can see it's higher by 1%. That's after a session where we saw, of course, your big tech benchmark fall by 1.5%. So we haven't completely erased the trade that we saw today, but certainly getting closer thanks to Apple and Amazon.
Absolutely, and always a reminder that this is an iPhone company. The vast majority of its revenue coming from that one device, $49 billion in the most recent quarter, but they've got other products as well, and maybe other products on tap. We want to take a closer look at some of those, including wearables, which has, well, raised some concerns amongst investors about the growth or lack thereof in that segment. Bloomberg's Mark Gurman joins us right now. And Mark, when we start to talk about Apple as a variety of products, do we look at this company as a variety of products, or should I just be looking at it as an iPhone company?
Well, it's an iPhone company because the variety of additional products you mentioned, people only buy them because they have iPhone, so they all play together very nicely as well. Wall Street had been anticipating that wearables, home, and accessories business to continue sputtering going into this earnings call. But maybe they forgot that a big chunk of the sales from that unit come from AirPods. And Apple released some pretty good new AirPods Pro 3 a few weeks ago as part of their September launch. There's also the new Apple Watches. The new baseline Apple Watch SE for a couple $100 is actually pretty excellent. Maybe for most people, the one to buy this year if you're new to the Apple Watch, especially for that price point and some of the changes you got to the display and health sensors. New Apple Watch Ultra 3 is fairly compelling with 5G and satellite connectivity. The Apple Watch Series 11 is a wash if you've got the Series 10 last year. But they did some good stuff in the wearables business. And that segment, which also includes things like HomePods, is going to get a little bit more juice next year. Security camera, smart home hub. So there's a lot to like for that unit, and this is a much-needed turnaround that we're seeing begin to come into place.
Well, that's where I wanted to go, Mark, because as you mentioned, the category is called wearables, home, and accessories. So let's talk about the latter half, home and accessories. You say that next year is going to be an important year in the context of Apple. I mean, how high are the hopes here in terms of what they might contribute there?
Oh, I don't think the hopes are high at all, right? I mean, we were getting to numbers well north of 10 billion a quarter for this segment, and I think that these new smart home devices will do little to do that. I don't think there's a ton of demand for the smart home devices that Apple is cooking up, at least in the near future. Amazon and Google, they really own and have cornered that market. So it's going to be a pretty difficult one for Apple to break into, but they just need it from an ecosystem approach to keep people locked in, to keep people from going who are already into the Apple ecosystem out to those competing devices who are launching a series of other products that are competing with the iPhone and the Apple Watch and what have you.
So as we move deeper into next year, I guess Apple's already in its new fiscal year, but into the next calendar year, Mark, talk to us a little bit about maybe what realistically we should expect. I know there's all this talk about a foldable phone, but I'm also curious about the company's chip strategy, which came into focus once again earlier this week with that potential combination between Skyworks and Qorvo, as well as a few other products that have kind of been lingering out there that I think people would get excited about if it actually comes to market.
So they're going to roll out the foldable iPhone at the end of next year. They're going to roll out a new M5 MacBook Air in March, a new M4 iPad Air in March, a new A18, these are all in-house chips, entry-level iPad in March. You're going to see the smart home devices in the March-April timeframe. You're going to see an updated AI strategy in the June timeframe. You're going to see some changes integrating AI into some of the services products in the September timeframe next year as well. A more significant update to the mid-tier Apple Watch at the end of next year. Aside from that, not a ton. 2027, you're going to see the rollout of smart glasses, the rollout of a tabletop robot. You're going to see a higher-end Vision Pro device, 28, 29. You're going to see, towards the end of the decade, a foldable iPad with a gigantic screen. So from a product pipeline standpoint, there's a lot in the tank.
All right, Mark, really appreciate your time. That is Bloomberg's Mark Gurman. Of course, Apple shares now higher by more than 4% in the after hours, Romaine.
All right, and of course, we are talking about iPhones, and of course, if you have an iPhone, it's got to connect to something. We talk a lot about the broader telecom space, which has been under pressure as of late, particularly outside of the United States, where, as we were talking with Nabila, actually not a whole lot of people have actually upgraded to new smartphones. I want to talk about Digicel. It's one of the biggest players in the Caribbean and in Latin America, across 25 countries. I'm pleased to say that the CEO of Digicel joins us right now, Marcelo Cataldo, to talk a little bit more about the state of the business and, of course, also about the devastation that just hit Jamaica. Marcelo, I am going to start off first with just the state of business right now, prior to the Hurricane Melissa rolling through Jamaica, and what the adoption rate had been for new smartphones, not just for Apple, but new smartphones overall.
Hi, thank you for having me, especially at this very critical time for us and for Jamaica. In the Caribbean region, we are behind Latin America and even further behind US and Europe in adoption of smartphone. We still have voice-only users in our region, so a lot of opportunity to connect more Caribbeans and more usage of data, of course.
And of course, you think about the hurricane and sort of the practicalities that come along with that when it comes to fiber breaks, down power lines. You talk about the progress that was being made. How big of a setback is this for you?
Well, I would say that in the face of Hurricane Melissa, our mission, Digicel's mission, has never been more clear, which is to connect Jamaica. Certainly, on the network perspective, we need to separate the two, right? First, the core of our network has held strong through all of the hurricane. Our data centers, our subsea connections, our international backbone all remain fully operational despite these extreme conditions. Now, what we're dealing with, as you rightly mentioned, is the impact of the access network with power outages, downed poles, fiber breaks, especially in a situation where 77% of the country does not have power grid. So it's a very difficult situation, right? Especially on the west side of the country, where Melissa went through the island.
And we should point out, I mean, your company, of course, was founded there in Kingston a few decades ago. And it gets to this idea, Marcelo, when we talk about I guess the precarious nature that a lot of Caribbean islands are in with regards to being sort of in the path of potential hurricanes. What sort of long-term measures are you seeing Jamaica and maybe some of the neighboring countries take to make sure that the infrastructure can hold up to storms, not necessarily a Category 5, but certainly strong storms that come through?
Yeah, every storm is a reminder that the Caribbean sits in the front line of climate change, right? We face stronger hurricanes, rising seas and everything. Our investments are focused toward resilience, as you rightly mentioned, right? In energy storage, backup systems, hardened size that is not just to survive the next storm, but can endure and assure continuity in the region. We learned a lot from Barry last year, so our processes, our procedures, our teams are now at the street, sizing the problems and working to bring everything up. So every year, every storm is a learning process, but we will continue to invest in future-proofing technology because our role here is to stay connected and not to stop on anything.
All right, Marcelo, we really appreciate you taking time, and we have to get you back on to talk when things are maybe a little bit less extreme down in your neck of the world. Marcelo Cataldo is the CEO of Digicel, based in Jamaica, as Hurricane Melissa just tore through that country. A huge loss of life and a huge loss of property.
Certainly a story that will continue to follow. But let's quickly turn back to these markets right now. Of course, sorting through a lot of the earnings that we got after hours. Apple still ripping higher, up about 4%. I said that was ripping, but then you take a look at Amazon, higher by more than 11% after hours. We'll see if these gains hold through the phone calls.
Well, that's what I'm curious about, too, here. We are seeing actually a little bit of a bump in futures heading into tomorrow, so maybe that gives us some sense. I guess as long as you have a name like Apple, and I guess you can throw Amazon in there, but more importantly, Apple at 4%, I guess the market's going to do okay.
Yeah. If those numbers stay green to the magnitude that they are right now, you would imagine you'd see the Qs, you'd see the S&P 500 perform. You also have Coinbase and Reddit moving higher after hours as well.
All right, we appreciate you joining us once again here on The Close. We'll be back tomorrow at 3 p.m. Eastern Time. For all your politics coverage, stick around. Joe Matthews up next at the top of the hour.